The financial system in the United States has been under severe crisis for some time. If you look at the history of the last 25 to 30 years, you'll note that we've had repeated financial crises. The basic problem was that in 1999 we tried to solve that problem by creating a new type of bank, that is a bank holding company, where banks could do virtually any sort of financial service that they wanted to do. Now, prior to that date, we had legislation which was called the Glass-Steagall New Deal legislation that separated banks into commercial banks that dealt with household deposits, basically, and investment banks that took on risky banking business. The 1999 legislation put those two kinds of banks together, and it only took about 10 years until they were taking risks that were excessive with basic household deposits. And that's basically the first factor that created the difficulties that we have experienced. The current crisis was basically a surprise to everybody. It was a surprise to politicians, it was a surprise to economists, and interestingly enough, it was even a surprise to the people who were running the financial institutions that got into crisis. Now, there are a number of reasons for this, but the basic reason is that people believed that the old sets of regulations that were set up under the New Deal were not sufficiently competitive. That is, they created monopoly positions for certain types of banks, and these supposedly led to inefficiencies. Well, we now know that those inefficiencies, on the other side, led to a certain amount of stability in the system. But the idea was that legislation should be passed in order to allow greater competition in banking. And it was the result of that increased competition, which everybody thought would lead to increased efficiency in the financial system, which led to increased instability. So that basically economists were very much in favor of reducing regulations. Politicians were very much in favor of reducing regulations, all of them believing that the market would provide the kind of guidance to the financial system that would create stability. Well, we've now discovered that markets need regulations in order to work efficiently, and in the present case, the problem was there were too many sectors that were not regulated. As an example, the Federal Reserve technically had the power to regulate mortgage originators. That is the main source of the subprime mortgages that were part of this crisis. They chose not to do so. They chose not to do so for competitive reasons. That is, they believed the market was sufficiently efficient that they did not have to take active control over this market. Well, we have seen what the conclusions were from that sort of decision. Well, the problem that policymakers faced in the current crisis was that they were usually one step and sometimes two steps behind exactly what was happening in the market. Now, one of the reasons for this was they believed the market itself would be self-adjusting. That is, the efficiencies that had been created in the market, they thought would produce the counter pressures that would return the market to some sort of stable position. So the first response was always, well, we'll allow the market to work this out and eventually things will be all right. Then when they discovered that this was not happening, they had to intervene. So if you look at, for example, the responses of the head of the Federal Reserve, first to the subprime crisis, his response was, well, this is a relatively small part of the mortgage market. It's nothing that we should be particularly worried about, and things will take care of themselves. The first part of the statement was correct. That is, subprime was an extremely small part of the entire mortgage market, something between, well, maybe 8–10%, something that one would normally not be excited about. The problem was that people were not cognizant of the way the subprime market was intertwined with the rest of the mortgage market, and they were also not cognizant of the fact of the way banks were operating their balance sheets and the way they were using the assets that were being created by this market. So that once the subprime market went down, it very quickly had an impact on the kinds of structured financial instruments that contained the mortgages. You can say, well, we have no problem with the mortgages, and then all of a sudden the mortgage-backed securities that contained those mortgages were also in difficulty. So this was sort of a second step. Said, oh my goodness, now we don't have only a problem with subprime mortgages, now we have a problem with residential mortgage-backed securities. And then people said, but these residential mortgage-backed securities, which contain thousands of mortgages, that is, they could be 3, 4, 5, 6,000 mortgages, these things were then packaged, 10, 12, 15 of them, into collateralized mortgage obligations. So that there was this pass-through of the difficulty from a relatively small sector into a larger sector, into an even larger sector, and the collateralized mortgage obligations represented a very large proportion of the assets that the banks were holding. So it was always a question of being sort of one step behind in terms of responding to the crisis. The subprime mortgages could all have been purchased very easily by any of the larger hedge fund managers. They could have simply been purchased, given back to the householders, and that would have been the end of the problem. But the fact that the response was always, as we say, sort of 10 seconds late and $2 short, the thing kept expanding, so that nobody was looking ahead to say, well, what are the implications of this on the rest of the system? And suddenly the entire system was involved. So that instead of having the timely, appropriate response to stop the crisis, the intervention came after the entire system had already broken down. So to say, was the response appropriate? Well, once the system had broken down, there was very little choice of what to do. It was necessary to intervene. Now, the other part of the story is that by that time, the financial sector was technically insolvent. Virtually all of the banks, if you took the value of their assets and the value of their liabilities, they could not pay off their liabilities with their assets. But the real problem was that the value of those assets had declined. Why? Well, the value of an asset depends on an income flow. Somebody has to be able to pay the interest on the borrowing. Who was that? Well, it was the householder, the people who were holding the mortgages. So the alternative response to the crisis would have been, well, we can save the banks, or we can try and go back and make sure that the households can pay their mortgages, because that would make the assets that the banks are holding good. Well, we're now, the crisis was Ides of September 2008. This is now 2012. And the administration is just getting around to trying to propose a serious program to help households who are insolvent by providing them with, possibly, we hope, with a mechanism by which their mortgages can be written down and they can be put in a position where they can actually pay those mortgages. So you can say, first of all, the response was inadequate and too late. And when the real response came, it came only in the financial sector and completely ignored the households, which were the real source of the instability. So that if there was going to be a bailout, the households that should have been bailed out rather than only the banks. The response that we got from Congress to the crisis was that we're going to fix this now, and we're going to fix this forever so that we never have another crisis. Well, this reminds me of what people said after the First World War. This is going to be the last war that we have, the war to end all wars. Then, 20 years later, we had another one. It's very interesting that politicians, and to a certain extent economists, always think that they can fix the system so that crises will never occur. They never succeed. And there's a very good reason that they never succeed, that they can't succeed. That just like the generals, they're always fighting the last war. And the financial system is a system that works on the basis of profit, and it works on innovation, so that the system is always responding to the regulations that you're putting on the system. Subprime mortgages didn't exist in the real estate crisis that we had in the end of the 1980s. We introduced regulations that were supposed to make it impossible to have another real estate crisis. Well, we had one. So part of the difficulty is that the regulations are always regulations that are looking at the last set of innovations rather than looking forward to the new ones. So the first thing is that the regulations have to be more active. They have to be more forward-looking, and then they also have to put controls on what you allow financial institutions to do, the kinds of innovations that they take. Now, the 1999 legislation said basically financial institutions can do whatever they want, and they can introduce whatever financial innovations they want. Subprime mortgages, no problem. Let's let the financial institutions do that. Much of the crisis could have been avoided if the Fed had simply said, no, we don't think this is an appropriate instrument for institutions to be selling. And that would have stopped, at the beginning, the source of the crisis. If we're trying to have a forward-looking set of regulations, which is probably necessary in order to get financial institutions into a more stable condition, there's going to have to be regulations on what financial institutions can do. Now, one simple way to do that would be simply to go back to the 1999 legislation and say, this was a mistake. The regulations that we're currently using are trying to say, let's try and fix that legislation so that it doesn't produce a crisis. It's always going to do that. So one of the steps is to try and go back and to see what parts of the 1930s legislation, the Glass-Steagall legislation, can be introduced in terms of placing limits on precisely what banks can do. Now, it's always the case that a financial institution, when it's looking at a new innovation, will go to its regulator and ask for what is called a comfort letter. Say, I'm thinking of doing this. What do you think? Is it a good idea? We have to pay a lot more attention to those requests and to make sure that they're not going to be creating instruments that produce additional kinds of instability. Same thing in terms of what we call synthetic securitizations, which cause most of the big problems in the collateralized mortgage obligations. If anybody had looked at those seriously, they would have said, no, this is not something that banks, in fact, should be selling. But regulators allowed them to do it because banks argued that they were extremely profitable. In fact, they were. But they also produced the biggest crisis that we've had since the 1930s. It's interesting that the financial crisis that we had in 2008 was different from prior financial crises in a number of respects. Usually, we think that financial crises are going to occur in underdeveloped or developing countries. And in fact, in the 1990s, we've seen crises all over the world, except in the developed countries. So first, it's interesting that it occurred in what was supposedly the best regulated financial system in the United States. And secondly, it's interesting that it spread so quickly to the rest of the developed world, and particularly spread very quickly to Europe. Now, in Europe, there are two different reasons for this spread. One is that if we take the financial systems that operated in the United Kingdom, Ireland, Iceland, and a number of these places, they were very similar to the United States system. So more or less, they went through the same sorts of problems. High prices in real estate, the use of those high prices as collateral in order to generate lending, and extremely risky lending, in very simple terms, without talking about the structure of the way it was done. On the other hand, the continental systems were much more regulated, and in fact did not enter in the same way. For example, Germany never had a real estate crisis. It never had a real estate bubble. The German banks also got into difficulty. And the way they got into difficulty was by buying the mortgage paper and the structured mortgage products that were produced by the US banks and by the British banks, so that they imported, if you like, the instability into their own system. Now, this was the first part of the transmission. The second part of the transmission was that as the result of the difficulties in the financial system, both in the UK and in Europe, governments were forced to intervene to bail out the banks. Now, this created a very large increase in government indebtedness. And within the European Union, and in particular the euro, the stability of the euro depends on governments having very low ratios of debt to GDP and having very low deficits. When these mushroomed, that is, if you look at a country like Spain that started out with a position of virtual surplus in terms of its government balance, suddenly went into very, very large deficit, bondholders of debt of the Spanish government said, how is Spain going to pay us back? And this is when it spread to what we call the sovereign bond crisis. And this is what we're now looking at in Europe. Now, Greece happened to be a particular case of this, but it was something that spread throughout the European system and also spread to the Italian bond market and even to the French bond market. So this idea that the use of government debt in order to bail out the financial system, in a sense, boomeranged and created a second tier of indebtedness and a second round to the crisis, which the United States doesn't have, because the United States can still pay its debts in terms of dollars. Unfortunately, Spain can't do that. Spain has to ask the European Central Bank, and the Germans won't let the European Central Bank pay off Spain's government debt. The current crisis is interesting basically because it's a crisis that started in developed countries and then moved to the rest of the developed economies, and then very quickly enveloped most of the developing world. As we said, this is the opposite of what usually happens. It's usually Brazil gets into crisis or Korea gets into crisis, and then it moves to the rest of the world. In this case, developing countries were hit in two particular ways. The first way is the emerging market economies. That is, these are what we often call the BRICS, okay? Brazil, India, China, Russia, and to a certain extent, South Africa. These countries have had very large inflows of capital from the developed economies. Now, if I'm a financial institution in a developed economy and I'm suffering very large losses, and I have money invested, say in Brazil or in India, to cover those losses, what do? I sell my investments in these kinds of economies. I sell my investments in Brazil. So that there was a very, very large and immediate impact of capital outflows, but these were not the normal kind of capital outflows, that is the risk of crisis in Brazil. It was simply the financial institutions bringing their money home. So this was the first impact. So you had a very, very strong impact on exchange rates that depreciated substantially. In Brazil, this caused a near breakdown in the financial system because of the impact on the way exchange rate derivatives contracts had been used to allow firms to finance themselves. And in other developing countries who were more or less isolated from the main capital flows from developed countries and from the use of the complex derivative or structured financial instruments, the other impact was in terms of what we call food security. One of the basic impacts of the run-up to the crisis was that financial institutions had been using their speculative capital not only in real estate, but also in terms of commodities. That is, they were buying commodities through commodity index funds in order to profit from the increase in prices. Now, this caused tremendous disturbances in primary commodity markets and in particular in food markets, so that developing countries were hit already before the crisis collapsed in terms of very rapidly rising food prices, in particular food grains, and oils had very sharply rising prices. And then when the crisis came, prices collapsed. And a lot of the providers to these countries found difficulty in supply. So in what we call the least developed economies, the impact was basically in terms of the increased volatility in terms of food prices. Also, these countries depend very much on their ability to export to developed countries. Well, the first thing we saw within 2 months of the crisis, world trade had collapsed by something like 15 to 20%. Now that meant that the least developed countries couldn't sell their output, they couldn't afford to buy foodstuffs, and they entered into a very, very severe crisis in terms of what we call food security, the ability to feed the people. So you have this sort of different impact on the middle income and the least developed of the developing world. I mean, if you look at the way the banks behaved, I mean, one of the more complicated explanations is that after the dot-com crisis, okay, banks lost a lot of potential revenue because there were no longer any, the stock market collapsed. It was no longer possible to launch new tech companies. So what they did is they moved into two areas. The first one was real estate, and the other one was in commodity speculation. And they sort of moved in tandem. And if you look at the prices, if you do a chart of, of house prices and a chart of commodities, you find that they move almost one-to-one together. And when the one collapsed, the other one collapsed. So it went very much as a thing. Now the difficulty that we have today is that prices have now gone, commodity prices are now back to where they were before the crisis, because most financial institutions have gone back into commodity speculation, whereas it's in now real estate you can't do anything anymore. So that part of the crisis is still there, and that's why it's still a problem. The impact of the crisis on Europe has been primarily now in terms of sovereign debt difficulties. And if we look across the various European countries, they all have a very diverse debt to GDP position and deficit position. Now everybody says currently that Germany is in such great position. Well, Germany is not. Germany also has a debt to GDP ratio that's higher than it's supposed to have under the conditions of the Growth and Stability Pact, I should say, Stability and Growth Pact. Italy, on the other hand, has a very high debt to GDP ratio, and it has always had a high debt to GDP ratio. It went into the euro with a ratio which is approximately as high as it is today. Now, if you've got a very high debt ratio, it means that you pay a lot of interest servicing that debt. And to service that debt under the euro, what you have to do is to generate enough fiscal receipts in order to be able to pay your bondholders. So it's crucial that the economy is growing sufficiently rapidly so that it generates a sufficient amount of income so that you generate enough tax in order to pay your debts. Now, before the crisis, Italy was not having a great deal of difficulty doing this, aside from the fact that growth had been very disappointing. That is, Italy doesn't grow as rapidly as it should. I, at one point in my life, worked for Confindustria as an advisor to Guido Carli. And we always had a sort of rule of thumb. We said, well, if the politicians don't mess up the economy, it'll grow at 3%. Well, Italy has not seen 3% in a long time. If it were growing at 3%, it would not have any difficulties whatsoever. Now, is this peculiar or not? Well, it's not peculiar because hardly any European economy grows at not even 3%, but 2% is in fact the maximum level that the European Central Bank considers as being compatible with stable inflation. So what you have is an inherent paradox in that the European Central Bank, in order to keep the euro a strong currency, believes you should have an inflation rate and a growth rate that makes it extremely difficult for highly indebted members of the Eurozone to meet their debt service. And this is the basic problem that Italy has. It has it a little worse than other countries because its growth rate is a little worse and its debt is a little higher. But almost all of them face the same difficulty. We're currently in a position where the European politicians are trying to decide what to do with Greece, basically, whether it's going to stay in the European Union or not. And the biggest difficulty is what to do about a certain amount of Greek indebtedness that has to be paid off in the middle of March. Now, if we look at the holdings of most of the Greek debt, now a large proportion is held by the European Central Bank itself. A large proportion is held by banks of other European countries, and almost all of them have now written down that debt, that is, they've taken losses of 70 to 75%. Deutsche Bank says that it has it on its books at 30%. BNP Paribas has just announced its results. They have it on their books at 25%. So most of the holders of the debt, okay, have now already accepted that they're going to have substantial losses. There are a small number of private investors, hedge funds, or what we call vulture funds, who in fact have purchased debt from financial institutions at, say, 25, 30 cents, who are hoping that they will get paid off at 100. Okay? So this is the basic speculation that we've had in the market. But certainly this didn't cause the problem. In fact, this sort of speculation is only possible after the problem already exists. That is, after the second-hand market for the debt has been driven down substantially, where you can buy in the hopes of being paid off at 100. So that basically speculation had very little to do with this. Instead, the difficulty came when normal financial institutions, banks in Germany, banks in France, banks in Belgium, banks in Holland, who were holding large amounts of sovereign debt, and they were holding it basically because it provided a reasonably good, safe return, and under the BIS regulations, they had zero capital requirements on it. That is, they did not have to take capital against it. So the regulatory system was encouraging them to hold it. When the Greek government suddenly announced that their deficit was about 4 percentage points higher than anybody had anticipated, everybody said, well, maybe Greece is not going to have enough money to pay us back. And that's when the crisis started. And that's when the banks started to sell their debt. And that's when they stopped refinancing the debt that was rolling over. And this is when the interest rate spread started to go up. Now, when the interest rate spread started to go up, this meant that it cost more and more for the governments in terms of interest service in order to finance their debt. So the deficits went up by even more. And you started with this circular process in which the more uncertain banks were that Greece could repay, the less willing there were to refinance, the bigger the spreads became, and the more difficult it was for Greece to meet its debt payments. So basically, it was, as I said, a structural problem. The speculation came somewhat later in the sovereign market. The increase in bank spreads obviously had a very, very great role to play in generating this circular process by which the difficulty in rolling over debt became even more difficult. So that one of the first things, or the easiest ways to stop the crisis, would be to try and reduce those spreads. The European Central Bank made an attempt by actually buying sovereign debt of Greece, Portugal, and even at some stage Spain and Italy in the secondary market. That is, to try and ensure investors that prices of this debt would not have moved so low that they were going to take losses. The problem is that the European Central Bank technically cannot intervene directly, so that they were always operating in the secondary market and under great criticism from, in particular, the German Bundesbank. So an alternative would be to provide another source of absorbing the debt and providing funding to roll over the existing debt. Now, this is what the European Stability Fund was supposed to do. The problem there was that the fund was set up with an amount which would have been sufficient, possibly, to rescue Greece, but certainly not enough to rescue Portugal or Spain or Italy. So again, we're in a position where the responses have always been insufficient to the potential problem. So the very simple way of getting spreads down would be to allow the European Central Bank or some alternative institution. The European Investment Bank has been mentioned as one possibility, to give a guarantee for short-term funding on the indebtedness. And this possibly could bring the banks back in to the funding market. But the difficulty is that the banks are afraid that if they buy the new debt, and we're now discussing that on the old debt the banks are going to take a loss of 75%, that this will also apply to the new debt. So it becomes a very, very difficult problem to try and get the private markets to do this. The US financial system was very highly regulated after the 1930s crisis. In the 1980s, economists thought that they could make it more efficient by reducing those regulations. The Reagan administration decided that even regulators would be unnecessary, and Alan Greenspan believed that the market would provide sufficient regulation to provide stability. Well, we now know that none of those propositions were in fact correct. In looking back at the crisis, one would say that this is something we could have stopped much more quickly. The problem was that policymakers, believing that the reduction in regulations and the greater role for the market would provide some sort of self-regulation, so that the markets would more or less take care of themselves. So the regulators were always too late in recognizing the difficulties, and they were also unable to see the interrelationships between crises, for example, in the subprime mortgage market and in other parts of the financial system. And it's in fact those interrelationships that caused the eventual breakdown. So that it was always the case that the regulators were intervening too late, they were intervening too little, and they were unable to see the implications of the crisis for the broader performance of the system.